Last year, Pakistani startups received half their funding from emerging market VCs. This year, most emerging market VC firms are sitting on the sidelines and waiting for the market conditions to improve. However, my guest in this episode of the Misaal podcast is actively funding deals in Pakistan and most recently invested in Truckistan. His name is Michel Friedman and he's a founding partner at Reflect Ventures, an early stage VC firm focusing on transportation, logistics, supply chain, and distribution. Let's listen in. Welcome to the Misaal podcast. Michael, how are you?
Very good, Sahid. Thank you very much. Great to be on here.
Thanks so much for joining me today. Really excited to learn about Reflect Ventures. And it's been a while since I've spoken to an investor that's investing in Pakistan. So mostly I speak to founders. So this is going to be great. Let's get started with a quick introduction. Please tell me a little bit about yourself.
Great. So maybe I should start just by saying, what is Reflect Ventures, right? Reflect Ventures, we're three partners. I'm now in Dubai, just moved. I have a partner, Jor, in Shanghai, and a partner, Dan, in Boston. We invest in emerging markets, B2B and B2B2C, supply chain, distribution, logistics, transport-related fintech. We are very narrow in terms of what models we invest in, but very broad geographically. I'm one of the founding partners. I actually mainly run the administration and investor recruitment. Right? Most of the work with the startups and choosing the startups we invest in, that is handled by Dan and Jor.
I was going through the website and I saw that, it says that there's a generational opportunity to invest in certain emerging markets. Can you talk a little bit about that? What does that mean as a thesis?
Well, two things are happening. Number one is smartphones are becoming affordable for people in emerging markets. A truck driver in Pakistan is not going to buy a smartphone to play Angry Birds. It's much too expensive for that. But if you tell him you can do 20% more loads each year because you've got a mobile phone in order to get a booking, arrange bookings, and get loads, and then you're going to spend more nights at home, you're going to have more money for your family. Now it's worth it to him to buy a smartphone. If you tell a gig rider, buy a smartphone, you can become a gig rider. He will invest in a smartphone in order to do that because even after making the payments for the phone, the income for his family goes up. Now, this makes business models possible that did not exist 10 years ago. In addition, other things like the dramatic decrease in the cost of building systems to support these kinds of businesses, the availability of cloud computing. You don't need to go and arrange for your own computers in a hosting facility. The availability of all of these SaaS tools to run your business, the availability of e-payments, they're all making models possible that didn't exist before. I was living in China when all of this hit China, and I saw what happened, how China leapfrogged all of a sudden over development that took the United States decades. And in some ways, even were able to go past the United States because they did not have the legacy systems holding them back. The same thing is now happening in other emerging markets. That is number one. Number two, the demographic dividend. I know people talk about the demographic dividend, particularly in Pakistan, but it's happening all over. In the next 80 years, the world's population is going to increase by about 2 billion people. And they're not going to be in China. They're not going to be in the United States. They're not going to be in Europe. They're going to be in Pakistan, in Nigeria, in Brazil, in these countries, the countries we're investing in. Even if GDP per capita stays constant, which I don't believe it will, the GDP is going to go way up, and the businesses that these people need to use in order to survive are going to grow. And of course, growth is what we invest in.
Of course, there are other countries that you invest in. What makes the Pakistani startup ecosystem or market different from other emerging countries?
So when you look at it in terms of, the number of people and GDP per capita, Pakistan's just a step above everywhere else. That was actually a bit of a surprise to me. For example, Bangladesh has a higher GDP per capita. The number of people is relatively comparable, but the startup ecosystem is nothing compared to what you have in Pakistan. If I had to guess why, I would say it would be a factor of two things. The diaspora, the Pakistani diaspora, plays a very large role, both in funding, in inspiring people as to what is possible based on models in other markets, in coming back home in order to help found these companies. And then Careem. Pakistan has an example of a $3 billion exit when Careem got sold to Uber. And that's a huge example. It tells people You can actually start a company in Pakistan and you can make a huge amount of money. You can invest in a new company founded in Pakistan and get a much higher return than you could by investing in property or buying gold for your family.
Investing in Pakistan comes with its own challenges in terms of, the way startup ecosystem is right now, especially with funding, it's almost dried up. So a lot of people, and including me, I would argue that it was mostly emerging markets, especially a place like Pakistan, that saw an uptick in funding for the, maybe in 2021 and 2022 might not be as, active in terms of funding for the next maybe couple of years or until the interest rates go down. Do you see that affecting what's being built in Pakistan? Because maybe it was easier to get a lot more money in the past for a lot of ambitious startups, but now it might be more about, hey, what's your revenue, what's your burn rate, and all those things are really, really important.
Absolutely. And that's good and bad. So I think we can all think of a startup in Pakistan, one that became very large very quickly, and where the idea of being cash flow neutral or cash flow positive was just alien to their thinking. And we all know what happened to that startup. It crashed and burned very dramatically, right? Now, it's good that people are going to be much more focused on positive cash flow. Right? And by the way, this is not a problem unique to Pakistan. Look at WeWork. Right? They grew to be, a multi-billion-dollar valuation. And now they're telling people we may not be able to stay in business because actually the cold light of day shines on their company. And they have to say, you know what, we need to be cash flow positive, and we can't, right? I don't want to, knock Pakistan uniquely on this, but this is good that it's trying to get that kind of froth out of the market. The bad thing is that people with good ideas are finding it much, much harder to get funded. And the reason for that is that as a priori, when you're looking at these companies, when there's a couple of people sitting around a table explaining their wonderful idea and how they need $50,000 to get started, it's very hard to figure out which one they are. And Pakistan definitely is facing headwinds. They are both political and economic. Some of those are economic problems unique to Pakistan. Some of them are the global macro, what has happened with the war in Ukraine, the increase in commodity prices. The decrease in the value of the PKR, the Pakistani rupee, that has a huge effect. If you started a company 2 years ago and you doubled your revenue in PKR, you are flat in US dollar terms. That is not that doesn't leave you with a good story to tell investors. Because, let's face it, our investors are not from Pakistan. They're not looking for PKR profit. They're looking for USD profit and USD return.
Yeah, so that conversation I've had with so many founders on and off the record about how are you planning to justify your valuation now since PKR is depreciated so much in the past couple of years, and they are still optimistic. They're we'll expand to different markets, the markets where we can trade, we can have more USD based revenue where it doesn't go up and down. And I'm that sounds all great, but realities on the ground are quite different, where past couple of quarters we've seen a couple of startups fail, stop operations and stuff. So how do you think entrepreneurs currently building or currently in the process of, maybe they have a product, they have revenue and all that stuff, they just want to grow, how should they be approaching fundraising as well as just the market? How do you assess the market right now?
First off, how do you approach fundraising? You need to recognize that even if your company is improved, the market is not improved. I was trying to explain this to one of our investees back about 6 months ago. And he's saying, my company's worth more. How can you be telling me that I can't raise the valuation I raised my last round at? And I said, well, the Pakistani government cannot raise money at the same cost as they were able to raise money for a year ago. The Pakistani government bond has dropped by 50%, the US dollar bond. How can you think that when that is the safe asset, and nothing has changed about it being the safe asset as far as any asset is safe in Pakistan, if that has dropped that much, then through no fault of your own, the value of a revenue stream from Pakistan, of a profit stream from Pakistan, has also dropped, even if you've increased the size of the cash flows that you're generating. This is a simple fact, and people need to be realistic. You cannot let ego get in the way. So number one would be talk to your existing investors, especially the professional ones, not the angels. The angels, they're psyched. You're selling more. The outside investors, they are investing all the time. They have an idea of what has happened to that valuation. They are looking at you in a much more clinical way. And if they're telling you you're not going to be able to raise the current valuation, well, they don't want to lose money. They don't want a down round. They're giving you the unvarnished truth as they see it, and they have more information than you do. And then you have to figure out how you're going to deal with that. And that is very difficult. Valuations are sticky. If you need to raise more money at a down round, that is a problem, especially because many people see that as a sign that your company has failed, which is not always true, especially in the current situation. Your company can be going up, and it can still be necessary to do a down round. But it impacts everything, including your ability to raise future rounds. If you can avoid it, great. But at the same time, this is not a time to be close to the edge on runway. You do not want to be operating your business with 3 months runway or even 6 months runway today. You want a year of money in the bank with confidence. If you cannot cut burn and you're getting close to a year of runway, you need to raise money now. And if you need to do it at a down round, do it, right? But think about what can be done. Talk to existing investors, see what can be done. One other thing I'll mention, by the way, also is that syndicates complicate this. One of the things that has happened since the last downturn is that syndicates have become huge in early stage funding. But when you go to a syndicate and you say, can you invest a bit more money? The syndicate operator does not have a fund. He cannot reach into his back pocket and give you more money. He has to go out to investors and ask for more money. And he can't say, guys, let's help out this company because we invested in it. It's a good company. Let's put in more money. Because the new syndicate is different investors than the old syndicate. He's got a fiduciary duty to the investors in the old syndicate. If it was a fund, he might say, yes, it makes perfect sense for me to take some of their money and put it into this company to keep it alive and get it over the hump. But he's also got a fiduciary duty to the new investors in a new syndicate. He can't use their money to bail out the previous. So this is going to have an impact. It has an impact right now where, investors want to help. Even the syndicate operator has goodwill and wants to. But the mechanics of syndicates actually mean that the syndicate operators say, well, we can't participate.
Do you personally prefer going in with other investors, or are you comfortable leading the investing route?
We definitely prefer to go in with other investors. We don't have the boots on the ground in Pakistan or in most of the other markets we're operating in. Going in with experienced investors, not just angels, but preferably institutionals, with those boots on the ground, it de-risks these deals a lot. These people also tend to be the ones that are, they're often able to help out a bit more when there's a big problem, right? And that, there's value to working with these people. They add value.
When you look at a startup and you're doing a due diligence, what are you really focused on? Are you focused on the KPIs for the business and stuff and the market and stuff? Or are you more focused on who the founder is, what the founder's background, his ability to lead, what kind of team he has, and all that stuff?
So it depends what stage the company is. As the company moves, at the very beginning, when you've got a couple of guys sitting around a table with an idea, all you've really got to go on is the idea, do you believe in it, and the people. The more the company has actually operated, the more the KPIs become an issue. And you can see that, throughout and at different stages, right? You look at WeWork. Originally people were investing based on, what was his name? The founder of WeWork. I'm blanking. Everyone was investing based on his charisma. And then as the company got bigger, people actually started saying, what are the numbers? And especially when you're ready to go public, those analysts are much harder to inspire than the guys who invest in startups for a living. And then you're looking at numbers, at spreadsheets, at KPIs, 100%. But even, if you're a good VC, you're not going to go and have a hair blown back moment and say, oh, wow, this founder is so wonderful, I must invest. You're going to go and look at the business. For us in particular, we are typically model driven. So we are looking for the business models that we believe match our thesis. These are models that add value, that are able to get big. We try to be in businesses that we think are natural monopolies or oligopolies. It's no fun to be in a highly competitive business. And that are regional, where a company can get very big in one region rather than having to win the entire world. We're not trying to find the next Facebook, But we're trying to find companies that can be, for example, the next Kareem, winning in a particular region of the world and then exiting very large.
The name you were looking for is Adam Newman.
Yeah, Adam, right. And we all know Mayoshi-san, Adam, you are crazy, but are you crazy enough? Okay, that's one way to invest.
So, what kind of deals are you seeing come through right now to you? And I know you invest at all stages, seed through Series A, Series B.
Series A, not Series B. Pre-Series A usually.
Okay, sounds good. What kind of deals are you looking at right now? Has there been a shift in terms of what kind of deals you see now?
You get a lot of deals thrown over the table. If you give us $1 million, we'll make this happen, or can you invest in my housing development? And housing developments make a lot of money, but they're not VC. And those aren't the ones that we spend more than just the time to send an email back saying, not really what we would do. If someone has something that looks real in our space, but it's just a couple of guys around a table, that's too early for us to invest. And we just send an email saying, please keep us posted. Sounds interesting. I wouldn't say there is a big difference in the kinds of companies coming over. There is a bit of a difference in presentation. Most people have learned to be a bit more focused in how they can become cash flow positive and to talk about that a bit more.
When you look back, was there something that you feel like, okay, you should have focused a lot more on, and that's what you plan on doing in the future?
Trucking we love. We keep investing in trucking. We've invested in Truckistan and Truckistan in Pakistan. We've invested in Camion in Turkey. We've invested in Upload, which is out of Mozambique, but doing the whole South African development community. And we invested in Cargon, which is multimodal, based out of Georgia. That's Georgia, the country, not the U.S. state. And focused on, the whole trade route from, the stands, Uzbekistan, and even Western China, across the Caspian, into Azerbaijan, from there into Georgia, into Turkey, and then out onto the Mediterranean. It's a great example of the kind of industry that we love, because trucking is a regional industry. There's no way that any of those companies are going really to compete with each other. Cargon is never going to try to arrange trucking in Western Europe. That's not what they do. And Truckistan is also not going to try to do trucking in Europe. The furthest they'll go probably is the Middle East, right? Or maybe Africa. So these are great businesses to be in, because you can keep doing the same thing again and again. You learn an industry. You get better and better at understanding that industry. And then you get better and better at identifying the companies and the founders that really understand that industry and how they can add value. I think that if I had to say anything, it would be that we want to be more and more repetitive, to stay in our lane, but to find the models where we can keep investing in companies that are doing a good job doing the same kind of thing in different places. And then, of course, one of the other things we do is we link them up with each other. I can give advice to the guys running Truckistan and Truckistan, Upload and all. And what's it worth? I'm learning about trucking, but I'm not a trucking guy the way they are. But when they give each other advice, and they say, I had this problem, here's how I solved it. Or I had this problem, here's how I could have avoided it. Now that has value, because they're talking to other people doing the same thing they're doing.
There are not that many opportunities for exits in Pakistan. It might be an exit through an acquisition like Kareem, or something else that happens where the startup decides to go public in a different market, because in Pakistan, it would be very difficult to go public at the valuations that the startups are currently at.
If you go and talk to an investor who says he knows the future, walk away. Unless it is the very, very basic things like, okay, there's going to be a big increase in population, right? Or smartphone adoption is going to increase. But if he's telling you, I know how companies in a place like Pakistan are going to exit in 5 years, walk away. So here are our thoughts on how this is going to happen. First off, you're right, Kareem. Kareem proves that a company started in a place like Pakistan can expand internationally in the region and then exit big. And we'd all be very happy if we invested in the next Kareem. There are a couple of other options. I don't know if you've ever heard of Kaspi. Kaspi is a Kazakhstan neobank, and they went public on the London Stock Exchange. And at one point before the crash, they had a valuation of $10 billion. That's a good exit by any measure. It is possible for companies in these countries to go public on an international stock exchange. It doesn't have to be the NASDAQ. It can be somewhere like the London Stock Exchange. It can be Singapore, and to get a good valuation. If you'd asked me 2 years ago, I'd said SPAC, 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 SPAC. The SPAC craze is more or less ending. SPACs were never as good a deal as people thought they were. There's a reason why the SPAC promoters were getting rich. And it's that SPACs were actually incredibly expensive compared to a regular IPO, but the cost was hidden, and many people didn't understand who was paying that cost. So I don't think SPACs are going to come back when the market returns, at least not in the same way they did, because people are beginning to understand that. The other options are strategic buyers. So, for example, a large conglomerate in Pakistan looking at one of these companies and saying, wow, they're actually generating cash flow. This is complementary to our other businesses. And why don't we buy them? So, for example, a real estate developer, we've invested in a company called Aware. They are warehousing. A real estate developer who develops warehouses could look at that and say, well, I can also now operate warehouses, and I can take my existing properties and monetize and generate cash flow out of that. That becomes a potential option. Then the final thing is roll-ups. So just as an example, we're investors in both Dastagir and Charity. Dastagir, you probably know. Dastagir is a proximity store, neighborhood store supply chain. They're supplying the neighborhood stores. And Charity is doing the same thing in Morocco, in Tunisia, in Ivory Coast, and for North African grocery stores in France. You look at those two and you say, okay, they're both doing well. They're both getting bigger. They're both still too small to IPO. Now, let's say that you merge them together, put the new parent company, say in Dubai, well, in UAE, or in Singapore, or somewhere like that, and you say, now I've got a reasonably large MNC. They're in a better position to negotiate with the big brands. They can actually negotiate directly with Coke, potentially, instead of with the Coke distributors in each country, right? And with the other big brand owners and big food distributors and such. So the margins are going to go up. A multinational seems a lot safer to invest in if you're a US investor than a company based in Pakistan. And now again, you've got a company that looks much better as a potential IPO on NASDAQ, NYSE, or to be purchased by one of the big international food distributors.
Like, what is one of the most misunderstood aspects of startup fundraising when it comes to Pakistani founders?
A bit hard to say, because honestly, the ones we end up investing in usually more or less get it. And that's why they get invested in. But I would give a few things that I see people often not understanding. First off, venture capital is a game of home runs. If you've got a portfolio of 30 companies, probably virtually all of your return comes from the top 2 or 3. A 1x or a 5x return is effectively 0x. It has very little impact on the return of your portfolio. What matters is the 100x. And that means that if you're going to talk about how you're going to be a conservative person building a company that will last, you're not going to go for the hyper growth. You are ruling yourself out as an investee. Now, I know that is contradictory, because then you say, well, but you got to be able to be cash flow positive relatively quickly. You have to figure out how to square that circle. That'd be number one. Number two is, everybody talks about how, they want venture capitalists that will help them out. In actual fact, when things are going well, the founders aren't really are less and less interested in talking with you. They feel that they know what's going on. When things go badly, they want to talk to you and they want your help. Now, what you have to understand about any VC is that they do not have the resources to work with all of their companies. Absolutely do not. And what they end up doing is exactly what you would do in a natural disaster. It is a triage process. There are 3 types of companies. There are the ones who are going to succeed no matter what. And you might say, well, then I don't need to help them. But actually, you're going to look at that, because if you can turn a 100x company into a 110x company, you're adding a lot more value than if you take a company that would have gone bankrupt and let them exit at 5x. So you will actually put resources into that. It's a bit different than in a natural disaster, actually. Then number 2 is the companies where you're going to make a big difference, where you're going to make the difference between success and failure. And there, yes, you will try to put in resources, but maybe not as much as the company that is doing well, but you think you can make it a little bit better. And then finally, the companies that either are dead or that have turned into lifestyle businesses. Remember, from my point of view, if a company is going to pay you a nice salary, if you founded a company, it's going to pay you a nice salary, it's going to go on forever, but it doesn't look like you're going to grow it big enough to exit in the next 10 years. You are, for me, a 0. I'm not going to ever get money to return to my investors. And then what I'm basically going to tell you is, I'm really sorry, I don't have time to help you out, and I don't think I can contribute that much. You're not where I'm going to put in my time. Now, I might not be that blunt, but that is effectively what will happen. And you talk to founders and they're saying, well, this VC who said it was going to be so helpful isn't answering my calls. And the short answer is, yep. And this is why. He isn't answering your calls because right now, in the limited time he's got to help his portfolio, you're not where his time is going to deliver the most value. Don't take it personally. Do something that shows that actually there is a big opportunity with you, or accept that you're not really where a VC wants to put in his time and money and effort.
Funny you mentioned the lifestyle business, and the reason I started smiling is because recently I heard there are like a couple of startups that have started to do that with different investors, where they're giving them dividends. And when I first heard about it, I was like, that makes zero sense to me. Were they like real venture capital investments, or were they just like, opportunistic, like, here you go, here's $100,000, you can pay us back in dividends? Because that doesn't sound right to me when someone says, oh, they have started paying dividends to these investors. And it's like, okay, so that's a different kind of, completely different kind of investment then.
There are two possibilities. Either the investor isn't really a venture capital investor, or they made a mistake in the kind of business they invested in. If the best use of that money that is being generated by the company is to give it back to investors rather than grow the business, then they're not a VC business. They're not a VC fundable business. And a VC who funded them made a mistake. Now, most of our investments are mistakes. Remember that if you're investing early stage, you expect 80 to 90% of your investments to effectively fail. Effectively failing means there will never be an exit during the lifetime of your fund, and you're not going to be able to sell them on to anybody else at any reasonable price. We get very few, VCs get very few 2-3Xs, unless they're very late stage. Most of the time, a company that has only grown that much, they're not sellable, and there is no exit.
Thank you so much for joining me today, and it was very insightful learning about what you have been up to and how you approach investing. Thanks again for being on the Misaal podcast.
Great, Saeed, thank you. It's very nice being on with you.
Thanks for listening to the Misaal podcast. I hope you enjoyed the podcast and will thank me by writing a review or sharing it on social media. Make sure you follow and subscribe so you don't miss the next episode. Thanks again. See you soon.